For a long time, Ares Capital, ticker ARCC, has been considered the gold standard in the BDC sector. They're the oldest publicly listed BDC still in operation, having launched back in 2004. Ares is also the largest business development company in the sector, having amassed almost $28 billion worth of investments in their portfolio. Despite suffering during the financial crisis, ARCC has delivered an average annualized return of over 13% since their IPO, beating the S&P 500. Ares Capital, as well as Main Street Capital, is often regarded as the best of the best when speaking of high-quality business development companies. And both of these stocks continue to be my favorites in this category of investments. I've been saying for years that Ares Capital is the best BDC for those who want a higher yield than what Main Street Capital has historically offered. Ares Capital was the first BDC I ever invested in, and it's the largest individual income stock in my portfolio. So it's been my favorite high-yielding individual company for a long time. But if you've been tracking the progress of this company, you might have noticed that this company's earnings have been falling over the past few quarters. Taking a look at their last 4 quarters, their net investment income has been going downward for more than a year. In Q3 of last year, Ares Capital reported core earnings of 58 cents per share, followed by 55 cents in Q4, 50 cents in Q1 of this year, and then 50 cents again in Q2. With their stock paying a quarterly dividend of 48 cents per share, we can see that as time has gone on, their dividend has been less covered by their earnings. With these results, some people have been concerned about the safety of this BDC's dividends. Let's go ahead and take a look at how this company is doing and determine the health of its portfolio and dividend payments. For starters, it needs to be said that the whole BDC sector has been going through many of the issues that Ares Capital is experiencing right now. In 2024, the entire sector was on fire, and most of these companies saw their earnings explode as interest rates started going up. BDCs that held an overwhelming amount of floating rate debt, which are investments that pay more when interest rates rise, started earning a lot of additional income. Companies like Capital Southwest, PennantPark Floating Rate Capital, Blue Owl Capital, and many others either grew their dividends, paid special dividends, or did both. It was a really good time for these companies when interest rates first started going up. But fast forward to 2025, and many of these companies are now seeing decreased earnings. There's a handful of reasons for this happening, and it depends on which company we're talking about, but I'm going to go through some of the biggest reasons. Non-accruals, which is the percentage of investments held by a BDC that aren't performing up to expectations, meaning that they aren't earning interest, have been rising. However, the rise in non-accruals has been so minimal that it's nowhere close to where these companies were back during COVID and the Great Financial Crisis. Ares Capital themselves has always remained well below the BDC average when it comes to this metric, so it's not significantly impacting them right now. One thing that is impacting all BDCs is lower borrowing rates. Throughout this year, BDCs have been earning less interest on their new debt investments. Rates have slowly been going down in 2025, and new business that's being generated isn't earning as much interest as it did just a few years ago. That's one of the biggest reasons for this decline. There's a few other minor things that contributed to decreased NII per share in Ares Capital's most recent quarter, though. They did exit a successful investment, which resulted in a pretty high tax bill of $44 million. But there wasn't any major red flags in their most recent results. In fact, they had a pretty solid quarter despite earnings going down. A lot of people who invest in BDCs are also concerned about aggressive interest rate cuts. It's now pretty clear that we are going to see at least one interest rate cut in 2025, and likely 2. But now some people, according to CNBC, are now suggesting we might get 3 cuts this year. Since all BDCs hold floating rate debt to a certain degree, lower interest rates will result in lower income being generated for these business development companies. This has a number of people concerned, but specifically for Ares Capital, they're not going to be as negatively impacted as much compared to other companies. This company only holds 69% floating rate investments, which might sound like a lot, but it's actually much lower than the BDC sector average. There's a lot of BDCs that hold well over 90% floating rate debt, whereas Ares Capital holds considerably more fixed debt and equity positions. We also need to talk about another metric with business development companies that I've never mentioned before. The reason why I've never discussed this is because I've never needed to. Ever since starting my channel, BDCs have been doing really well. But since income for these businesses is shrinking, we now need to look at this to get a good indication of how safe their dividends are. There's a number that BDCs refer to as their spillover. but I've also seen it referred to as their undistributed taxable income, or UTI, as well. This is how much money a BDC has left over that they could distribute to shareholders, but they don't. I suppose you can kind of think of it like an emergency savings account for when they don't earn enough from a quarter to fully cover their dividend without having to cut it. Ares Capital has had one of the best spillover balances out of all BDCs for a while. In their latest earnings call, their CFO said that they currently have about $1.29 per share worth of spillover. Given how their dividend is currently 48 cents per share, that's a tremendous amount of coverage. To give an example, let's assume Ares reports a terrible quarter. For some unknown reason, we'll assume their earnings plummet by 50% in their next quarter. Now that would have to be a pretty bad quarter, like something that would happen during the Great Financial Crisis. But as a result, they only generated 25 cents per share in investment income. To cover that 48-cent dividend and ensure it won't get cut and send the share price plummeting, Ares will take money out from their spillover to ensure they don't go through a cut. Assuming their spillover didn't change, it would fall from $1.29 to $1.06, still plenty of coverage for their dividend. Clearly this company and its dividend are still very healthy despite falling income. Anytime a BDC does have to reach into their spillover to cover their dividend, it does decrease their NAV. Most BDCs don't want to have to tap into it too much, and some will cut their dividend instead of depleting their spillover to zero. But again, Ares Capital's spillover is so massive, I don't expect that to happen with them. If we look at some poor quality BDCs, we can see that for some of them, they haven't been covering their distributions for several quarters. At this point, some of them would be much better off cutting their dividend, in my opinion. This BDC was heavily criticized, I remember, throughout 2022 and 2023 for not aggressively growing their distributions when their investment income was soaring. But Ares Capital went through the Great Financial Crisis, which is still likely to be the worst financial crisis of our lifetime. Since emerging from that, they've established their reputation as being much more conservative than other BDCs. The good news is that many other BDCs out there do have high amounts of spillover as well. And one more thing I should mention is that one sign the market isn't worried about their stock is its share price performance this year. Despite the falling earnings from their investments, shares of ARCC are currently up over 10% from a year ago. If Ares Capital was facing a crisis and their dividend was in grave danger, then investors would be dumping their stock. But people know that Ares prioritizes safety and is very conservative, and as income is falling in this sector, investors have been rushing into buying shares of ARCC. Unfortunately, it's currently very overvalued and trading near its all-time high. So if you are looking for a well-covered 8% plus dividend yielding stock, then you're going to have to pay a good premium for it right now. So to summarize, Ares Capital and BDCs in general could be facing more pressure in the quarters ahead. If you're worried about falling income due to interest rate cuts, there are things that BDCs do to ensure that they compensate for lower earnings due to rate cuts. BDCs do a lot of new business when rates get cut, so that'll increase their NII. They also use more leverage to boost their earnings to ensure that they still cover their dividends. But monitoring spillover is now going to be important when looking at these companies, which Ares is still very well covered. They could earn no income for 3 straight quarters and they wouldn't have to cut their dividend, it's that well covered. But feel free to let me know your thoughts, and with that being said, that's going to wrap up today's video. If you'd like to connect with me and see what's inside of my own high-yielding dividend portfolio, then feel free to check me out over on Patreon. You'll be notified when I make trades, and you'll get access to our Discord with other high-yielding investors. Thanks again for watching. Please be sure to like this video and subscribe if you want more high-yielding investment content. Thanks again for watching, and I hope you all have a great day.